Hi everyone, welcome to our webinar today. I'm here with Winnie. We can bow down for a word of prayer. Dear Heavenly Father, we come to you this evening. We want to say thank you for the gift of life. Thank you for the opportunity to be here. Thank you for this chance to help us learn more about taxes. Be with us as we go through this whole session and help us learn from this. At the end of it all, we'll be grateful and thankful for your Lord and King. In Jesus' name I pray, trusting and believing.
Amen.
Amen. So I would like to introduce the person seated on my right. Her name is Winnie Wangoi. She's a force to reckon with. Maybe just to begin. Yeah, she's a tax lawyer. She's a tax lawyer with 8 years of experience in tax and lawyering. She's also worked at one of the big four audit firms, that's KPMG, and has also been a senior associate in the leading East African law firm, that's Anjawala and Hannah, and currently a partner at Mark & Partners, the people we are doing this webinar with, in collaboration with. So I'm very, very excited to sit here and actually learn, and I hope all of us are as excited as I am. So maybe let me welcome you all. Let me welcome you all to today's webinar, and as we discuss taxes, as we try and understand why we are doing taxes. I remember a few months back we did a webinar on MRI, and there was a lot of questions just to help our investors know, as they're investing in real estate, what is that what's the most important tax that they need to worry about. Throughout the period of June, when people were filing for their income tax and all, the end of year taxes, their annual returns, many investors actually called just to ask and learn more. They were calling the finance department just to maybe you can say something.
Okay. Very, very nice. It's a pleasure to be here this evening, and thank you, Karen, for that humble introduction. Yes. We'll discuss about taxes tonight, and very many people are usually scared when they hear taxes. Very many people are usually very scared when they hear KRA. You know, you get a message or an email or even a call from a revenue authority officer, and you're scared. It's almost close to being called by a police officer. Yeah, and very many people shun from the topic of tax and think about it as a finance or an accounting role that is very complex and technical. But the reality is tax is alive around us and with us all the time. And I hope to make this session as easy, as fun, as simple as possible, and make it as engaging as we can in the session.
Thank you so much. I'd like to welcome the audience. I see many people have joined in. We have Sir John dropping in the fire emoji. Maybe you can tell us where you're watching from. Drop a fire emoji if you're here with us on the live chat. We also have Adam Sarah, who's here saying, hi, can't wait to learn. Mwendego is saying, looking forward to learning. Mwendego is one of our investors. Thank you for being here. Jimmy Kibunja, a lot of fire emojis coming in. People are saying they can't hear us. I hope it's better now. Yeah. Okay. So we're on the journey to 3,000 subscribers with 2,400 currently. And I'd like to encourage you to keep subscribing, because there's a lot more content coming in. There's so much we still have to offer, and actually stick till the end of this to know what more are we gonna learn on taxes. And it's not just that, it's more information to give you knowledge as you're venturing into this investing business with us here at TSAVO. Yeah. So this week is a very, very exciting week for us here at TSAVO. Because we are going to London, we're going to UK, yeah? We're going to meet our investors, the investors who have trusted us, never been to Kenya, have trusted us, have come in, have bought units with us, and some are actually on their journey to financial independence.
That's amazing.
Yeah, so check out the video that's on right now.
Your life?
So join. Martha has joined us here to just tell you more about the UK trip that they're going to tomorrow, actually.
Yes, tomorrow.
Yeah, excited?
Yeah, we're very excited. I think it's because of you, and all thanks to, you know, everyone who's tuned in and all our investors who've enabled us to grow this far and given us demand and a reason to you know, go global and go beyond Kenya. And so we're very excited. We'll be there by 4 p.m. tomorrow. And so we will start. Uko ni marathon. Hapo hakuna kukimbizana. Sasa ile mshaelewa tax, tunaanza tena kuinvest. So we have an itinerary. We'll be able to share it, you know, every day as the days go by. But maybe briefly, I can just share where we'll be. So we'll start our events on the 23rd of July, where we'll be in Luton. We are having the first community event, and we'll have a TSAVO barbecue with TSAVO friends there. I believe we have a number of investors who are there, so we are very excited. You guys will be the first people to see us. And then on the 24th, we're going to Northampton. We'll have a church visit, and we'll also have a barbecue there after. So unaenda kanisa, unatuombea, unaombea investment, unasikiza maneno ya investment, alafu tunakula kanyama ya kuongea maneno ya TSAVO. Then on the 30th, we'll still be at Nottingham. There's a KNWA event happening there on the same day as well, because we are going, 3 of us, luckily. So we'll be able to spread across as many, you know, places as possible, you know, same day, different places. So as well on the 30th, we'll be in Swindon, where we'll be holding our own TSAVO barbecue. So TSAVO barbecue with friends of Swindon. And the grand date, which is 31st of July, we'll be hosting all our investors, all referrals, everyone who wants to know about TSAVO. We are hosting a dinner at Doubletree by Hilton, at a place called Elstree near Watford, very close to London. And so we hope that you're able to confirm beforehand, so that ukifika unapata kajina kako kamekwa vizuri. Please come all. You'll meet us in flesh and blood. And then on the 6th, we'll be in Reading. There's a Kenyans in Reading event there. I know a few investors, and I hope you guys are watching, or you'll watch this later, you have promised to meet us there. So we'll be at Kenyans in Reading. Then on the 7th, we'll go back to Swindon. Swindon metupenda kabisa, and we love it there. And then on the 13th, we'll be in Manchester. The 14th of August, we'll be in Scotland in a very famous place called Calabash. I know you know it. And then on the 14th of August as well, we'll be in Leeds, and hopefully we'll have closed our chapter in the UK. We hope that this will be very fulfilling. And this webinar has come at a very relevant time, because very many people, especially guys in the diaspora, are not very familiar with our tax compliance, you know, just knowledge around tax. And, you know, when you get an apartment, what does that look like for you in terms of ownership, in terms of rental income, and today that is what you're going to learn. So we hope to see you there. I'll personally be there, our director Emily Mcharo, and one of my colleagues Rose Irungu. So tupatane tafadhali, musituangushe, and we are coming in flesh and blood.
Yeah, Kenya to the world.
Kenya to the world. TSAVO to the world.
TSAVO to the world.
Sawa, karibuni sana.
Yeah. Hey.
Great. Again, thank you so much for joining us. For joining us today as we dive into the meat and the reason why we are here today. Yeah, so many people in. I can see we are at 61. Thank you, Pam Konya. You're here saying you're ready to learn about taxes. Gladys Kioko, our investor, you're saying hello back. Happy to have you here. Jacqueline Mwangi, watching us from Kiambu. You're looking forward to learn on taxes. We hope we will actually make it as simple as possible. Yani, it should not be hard for you to digest. It should not be hard for you to actually understand it, and I hope it's relevant. Yeah. Thank you, Masitsa Kisi, for being here. You're putting up your fire emojis. Willie Nyayo, your fire emojis, I can see them. Thank you. So thank you everyone who's at the live chat engaging with us, and throughout the conversation, please feel free to ask any questions as we go deep into the conversation. So maybe Winnie, you can tell us why taxes?
Interesting question, and And taxes essentially are just a form of government raising revenue. So the government needs money, the government needs to find its investments, and taxes are used to essentially just collect part of government revenue to fund the government expenditure and investments. And in a country like Kenya, for example, this year our annual budget was at 3.3 trillion, and taxes contribute 2.4 trillion, are expected to contribute 2.4 trillion of that amount. So taxes are essentially just a way of government raising funds, and we all know why the government needs money to pay its revenue expenditure, to pay its recurrent expenditure for development and all the social and development needs that the government is required to do. And these taxes range from domestic taxes to customs taxes, and the typical domestic taxes that we all know are income taxes, pay as you earn, VAT, excise duty, and then when it comes to customs duties, we have import duty as a tax, we have import VAT as a tax, and we have import excise as a tax as well. So these taxes just go into the government kitty to fund its revenue. And maybe just to give an example, as of the financial year that ended 30th of June 2022, the government was able to raise we were able to hit our 2 trillion mark in terms of tax collection, and that was attributed by a growth in the taxes that we were able to collect last year. So we saw an increase in collection of corporation tax, we saw an increase in collection of PAYE, domestic excise, domestic VAT, and also customs duties. So actually the highest that Kenya has recorded in very many years, we were able to achieve it in the financial year that just ended. And of course, from where the KRA and the government sit, this is a good thing, because the target actually just goes higher in terms of collection. Great.
So you've mentioned different classes of taxes. You've mentioned these KRA. You've mentioned these parts in international taxes, and there's a lot of case laws around it. Maybe you can expound more on just the administration of taxes a bit more for someone who would not understand, or someone who's abroad and has no idea what the structure looks like.
Okay. So in terms of tax and tax administration, we usually have our domestic taxes, which are governed by the domestic tax laws. So one of the main sources of legislations of tax is Income Tax Act. The Income Tax Act will provide the mechanism and how to tax income. So it will provide you how to assess the tax base for both corporation tax and personal income tax, where PAYE and other personal income taxes will fall, and also prescribe the tax rate. It will prescribe the kind of allowances that you are eligible to take. It will prescribe how to assess that tax, essentially. And then we have the indirect taxes, which are covered under the VAT Act and the Excise Duty Act. So the VAT Act is basically a transactional indirect tax, where for any value addition that goes on in a good or a service, VAT is charged. So again, the VAT Act will just prescribe how to arrive at whatever is taxable. And the tax rates are also prescribed. And we have Excise Duty Act that does the same. And then for tax administration purposes, we have what we call the Tax Procedures Act that gives the guidelines of how to administer these taxes. So there are tax sanctions if you do not comply, and compliance would be in terms of payment, in terms of filing of returns, and if that is not met as required by the various acts, then there are tax sanctions and there are tax penalties to that, and other procedures in tax administration of how to manage tax disputes and how that is run. Then we have taxes that fall under the international ambit, and we borrow a lot from international best practice. like OECD, and we also have international taxes like transfer pricing. So that affects a lot of multinational investors coming into Kenya.
Yeah.
We have then jurisprudence that has developed over time from case law, and that also becomes an authority when it comes to taxes. So we have case laws that emanate from the tax tribunal, which is the first court for tax matters, and taxpayers are allowed actually, in the event of a dispute, to go all the way up to the Supreme Court, so long as you can demonstrate the public interest nature of that case for it to go before the Supreme Court. So generally, that is how taxes are administered. And under income tax, that's where most of the taxes that we interact with day to day would fall. So for corporation tax, for companies, which we all know is at 30%, and how to arrive and ascertain that tax base. What are we taxing? The base by the rate to get the tax payable. So that is there. For PAYE, this is income tax from employment. And again, for corporation tax, we usually, for Kenya, we do a source-based. So it's income that has been earned or accrued in Kenya. And then for PAYE, we will do a residency-based test. So if you're a Kenyan tax resident, then we tax you on worldwide employment income. And all that is prescribed under the various acts. Yeah.
Ah, great. So someone is asking themselves, there's a lot of jurisprudence. Yeah, jurisprudence. There's a lot of acts. There's a lot. How does that concern me as someone who's investing in Kenya? Because what happens in the normal day-to-day life of just any investor, it's I have earned this money, I have taken out all my expenses, and now I am investing. No one thinks about the impact of the things they purchase, the kind of products they go for, like all that. No one is constantly thinking about that. I think here at TSAVO we are big on you need to make sure you are classifying your needs, wants, and desires. There are things you really don't need, so you don't need to get them now. There are things, and for us, an investment comes from is like a need for us. So someone is asking themselves, what's the impact of tax on investment, like on just anyone who is trying to invest, whether in real estate or any other platform available. Yeah.
There's a saying that says there are two things that are certain in life, which is death and taxes. Unfortunately, it's so wrong that you can classify tax closer to death, which is a sad thing. So taxes are alive, and they're a driver to economy, they're a driver to your spending, they're a driver to your investments, they're a driver to basically most of the commercial decisions that we make in life, because in almost everything has a tax angle to it and a tax aspect to it. So if you sit and say tax is only a concern for big corporations, or tax is only a concern for someone in finance or accounting or HR if they do your payroll, then you're mistaken, because tax is in everything that you purchase. Before you make an investment decision, you have to think, what are the taxes that are involved? And those taxes even determine or impact what you take home in terms of your saving life cycle. So there are taxes that are consumption taxes. So if you are consuming certain goods, and these goods are considered what we would classify under the exercisable goods that are subject to excise duty, for instance, these are goods that are considered either harmful to you or luxurious, as it were before when excise duty was first introduced. And those goods have a high tax burden to it, to make this good very expensive for you to afford it, or to make it very expensive to deter you from bad habits or harmful habits. So in that regard, then tax impacts your purchasing power, tax impacts your take home. And even for corporations, everything comes after tax. So if you are going to pay dividends, you first have to pay tax. So if there are ways you can mitigate or if efficiently manage your taxes, then your take home sort of becomes bigger. And if if I know TSAVO is big on fire and encouraging people to invest and managing consumerism. So if your consumerism is high, part of the reason why that cost for consumerism goes high is as a result of taxes. So while you might think that bottle of beer doesn't count for anything, or that bottle of wine, excise duty beers, wines, and cosmetics and jewelry is very high. So are a driver to what you take home and what you retain to save and invest. Yeah.
Okay, that's a bit eye-opening, because I think for us here at TSAVO and what we sell, we say we sell FIRE, financial independence, retire early, and most of the Kenyans we know, even us, from growing up, we are bred in a culture of a lot of consumerism, a lot of I want to go out there and buy all these things, either to keep, to use, to eat, to drink, all those things, and you see, then you forget about the investment, and that's where TSAVO comes in to offer like very affordable investment. But at the end of the day, you can, because then again there are different levels of someone investing. I can be investing, but I'm only investing 10% of what I'm earning, while you're investing and you're investing 70% of what you're actually earning. So it's more of limiting your expenses, and I think just learning things like accessible goods, and understanding that purchase of these goods, in as much as might bring you fulfillment at the moment, at the end of the day, it's just a dent into your pocket. Yeah. Sure. And I like that part where you say it actually affects your purchasing power and saving and ability to save. Yeah. I'll go to the comments and just see what what people in the live chat are saying. So we have Amos Prosper saying tuned in from Feather Estate. John Kariba is saying he's getting lost. Hang in there. We are getting into the meat of it. Yeah. He's saying we should limit it into the TSAVO investment. So just hang in there. It's coming up. We need to. This is just to create a basis, to create an introduction, and then at the end of it all, it all drives down to you as an investor. As an investor in TSAVO. Ken Ashimosi is saying very informative session. I think Ken is also one of the partners at Mark and Partners. So yeah, thank you for tuning in. So in the advertisement for the webinar, we said we'd do like a dive into the Finance Act. Yeah, we talked about administration and all that, but some of us here, the Finance Act is out, or they're reading it somewhere, or it's such a big thing in the financial market, and you just don't understand how does it affect me as common mwananchi, someone who's 22 years old. Like how really does it affect me, and what is it?
Okay. So maybe just to answer to John, who said he's getting lost. Just we are getting there into the discussion, and it's very difficult to say we will limit this to what TSAVO does, but the two are connected. So if the taxes affect how you save, how you spend, how what you retain for investments, and that's what we're trying to bring forth tonight, that it is important to understand what these taxes are, how they affect your purchasing power of items, how they affect your ability to even save and ultimately invest. And even as you invest, what are the taxes that are applicable to those investments? And would you be investing and still losing so much in taxes? So are there efficient ways to structure our investments? And we hope in the next session those are some of the things we'll be talking about. So in terms of the topic tonight, we were going to discuss the Finance Act, and because we are just from a period when this has been passed into law, and it makes various changes to our domestic taxes that we have here in Kenya, and some of those changes affect your day-to-day life, and some of them will even affect your investment avenues in terms of the taxes that will be applicable on the return that you make when you sell, when you buy a certain type of investments. So that is what we're going to discuss. And in terms of how the Finance Act affects you, the Finance Act would make various changes to the tax laws that we've just discussed. And those changes would be at times to vary the tax rate, at times to introduce a new tax, at times to even create exemptions. And I'll give an example, like last 2020, 2021 during the COVID pandemic, there were very many changes, positive tax changes that were made to just cushion Kenyans from the harsh economic realities of COVID. And we saw a reduction in PAYE, we saw a reduction in income tax, and various other exemptions were made. So that's one of the methods, that's one of the ways that the Finance Act would affect you in your day-to-day, either as an investor or just as a common mwananchi. We have also seen the introduction of new taxes through the Finance Act. And I'll give an example. So we have a tax that was introduced in 2020 called the Digital Services Tax. And the Digital Service Tax relates to investments done online, so the purchase of goods and services in a digital marketplace. And this targets the non-resident companies carrying out business through a digital marketplace in Kenya. And there was hue and cry because online commerce has become very widespread in Kenya, and it's very common. We all order things online and they get to our doorsteps conveniently. And there was a lot of hue and cry from retailers and traders who are carrying out their businesses on Instagram and Facebook and online. But then the government exempted resident people from digital services tax, and it's only applicable to the non-resident people. We have an example of, monthly rental income tax that came up in 2016, and I'm sure this most of investors in TSAVO know, or they always have questions around it. So those type of taxes are introduced through Finance Acts. And maybe just to take this opportunity to handle monthly rental income tax, because I've mentioned that it's one of the taxes that was introduced. And so how this works is when the law was introduced, the idea was to tax income from residential units. So if you own a house that you lease, if you invest with TSAVO and you buy a house and someone lives in that house, then you are earning rent. So we were to tax that rent. And just to make its administration easier, it was put at a flat rate of 10% that is chargeable monthly. And then so that you don't have to compute it in a very technical and complex way, it is just straightforward administered on your gross rent. So whatever rent you get, the tax base, that becomes your tax base. The tax rate is 10%, and it is payable every 20th of the month through your online platform. So any investor falling between 24,000 a month, which rounds up to 288,000 a year, to 15 million a year in terms of rental turnover, would fall under MRI. If you are outside the threshold of 15 million, despite it being residential income, you fall into the bracket of corporate tax. And for that, it's usually 30%, and you deduct expenses. So it is on net basis, while MRI is simply administered on gross basis. So that's an example. And MRI is filed every 20th on iTax on your platform. So for investors in Kenya, either here at home or diaspora, you will need a PIN to buy this house. And the PIN has to be procured on iTax. So immediately your PIN is registered on iTax, and the tax is filed on iTax. And I'm sure at TSAVO here, together with Mark and Partners, are available to offer those services to people who will need assistance with filing of monthly rental income. So it's a final tax. So come the end of the year, or June, when we are all filing our income tax returns, and you declared MRI on your rental unit, you do not need to further declare it on your individual income tax return, assuming you're employed and you're filing your return based on your salary, whatever the employer has been deducting PAYE on. So if you're filing your return to capture the PAYE that was paid, you do not have to declare MRI any further. It is a monthly tax, and it's a final tax. And again, the beauty of the MRI is it is paid every month based on whether you have income.
Yeah.
So if the house is vacant and there's no tenant, then you do not have a base to even pay that tax on.
Yeah.
So that is how the administration of MRI works. And part of the changes also that we see from Finance Act is to also just maybe reduce tax or create tax exemptions. And one of the changes that will not came about this year, which is very positive, is the tax reduction on LPG gas. So your gas bill is going to go down because it used to be 16% VAT, now it's 8%.
Yeah.
So in terms of even, what you're talking about investment and ability to invest and your saving power, then if taxes are reduced, you are left with more to take home for investment purposes.
Yeah.
Yeah.
Yeah, and you see, unfortunately, just like you said, one of the things that are a given is like tax. It's like tax and death. Yeah. So it means wherever I am, whatever I am doing, in one way or another, tax is affecting me. Yeah. Most, and I think most Kenyans think it's irrelevant or that tax money, you'll never know where it goes because it's given to the government. But you see, something as impactful as just that reduction in VAT on LPG is actually gives you more money to save. It actually increases your saving power, because you have more money to take home because goods have gone lower. The prices of goods have gone lower. So yeah, I think that's very, very insightful. Maybe we can talk about the major changes in the 2022 Act, just as you try and relate it to investing and purchasing and purchasing power of investors.
Okay. Generally, the Finance Act, as I've said, would make a raft of changes, various changes to the various acts. So we'll have changes to the Income Tax Act, changes to the VAT Act, to the Excise Duty Act, to the Administration of Taxes under the Tax Procedures Act, and also other acts, really. So we'll have changes to the Capital Markets Act, changes to Insurance Act, and trying to condense all the changes that have been passed through the Finance Act into this session would be a difficult task. One, because of time, and two, because we would want to focus more on the changes that will affect your investment ability and leave you with knowledge of how these taxes affect how you consume your money and how you invest your money. Yes, so I'd like to just narrow and limit the changes to some of the things that we feel you would like our investors to know, and then if there are any investors in the session or any viewers who would further like to know the type of taxes and the changes that affect maybe their businesses, we can always plan for a different forum for that.
Yes.
So please, if you'll allow me, I'll just highlight maybe 3 very important changes. And to start us off, I'll just like to bring you alive to the fact that capital gains tax, which is a tax that is applied on the sale of property in Kenya, and property is defined as or is considered as shares, investment in shares, investment in real estate being land, building. So the taxes that are applicable on the sale of those kind of property, it used to be 5%, and I'll give you the origin of CGT. Capital gains tax was suspended back in 1985, and then it was reintroduced back in 2015. And when it was reintroduced, it was introduced at 5%. And just to put into context, Kenya, for the longest, had the lowest capital gains tax rate. And even at the moment, despite it going up to 15, so one of the key changes that we've seen is the increase in CGT by 3-fold, from 5% to 15%. So despite it going to 15%, it's still the lowest in the region. All the other countries in East Africa charge capital gains tax at 30%.
Jeez.
Yes. So when you buy a house and you want to sell, when you buy land and you want to sell, capital gains tax would apply to you because it's a seller's tax. So it is payable by whoever is selling. at 15%. The change comes into place from 1st of January 2023. And what we see, how CGT works, is we would take your transfer value, so whatever consideration that you're going to get on selling that property.
So in this case, that would be the purchase price of the unit. So
price.
you're 1.8 for a studio.
Yes. So so if you're going to sell it, so if you're going to sell, so assume you buy a studio at 1.8.
Yeah.
And then 3 years later, 5 years later, for one reason or the other, you want to sell it. Yes. So Karen bought a studio, it was 1.8.
Yeah.
5 years later, the studio is at 2.5. So the transfer value would be 2.5.
Yeah.
Because that's what you're selling it at.
Yeah. Yeah.
Yes. So it will be 2.5 minus what we call adjusted cost. So adjusted cost would be the historical cost of the unit, plus any other incidental or improvements on that incidental cost or improvements on that unit. So if there is legal cost, if there was stamp duty that you paid when you bought that unit, you are allowed to deduct that from the transfer value. So the difference that you get would be your tax base for CGT purposes, where when we have said how to ascertain a tax base. So that tax base, you will multiply it by 15% to get what is payable, as CGT. CGT is also payable on iTax and by the 20th. So in Kenya, we have a self-assessment regime. So you assess yourself, that CGT, and then you declare it and pay it on iTax. So, so the increase of CGT, what it does is so imagine if you're going to pay, if you're going to sell this house at 2.5,
yeah,
and then you have to pay capital gains tax at 15%, and we compute and find that the capital gains tax is going to be, say, 300,000. So instead of your take home being 2.5, your take home becomes 2.2. Yes. So and as you say, taxes affect us in terms of how we invest and the returns that we get from investment. This is just a live example of that kind of tax. And the Act also provides for a lot of tax planning around CGT. So there are certain exemptions that you can enjoy when you're disposing of or when you're selling property around CGT. So there are exemptions around family companies. So if a company that is owned between spouses and children, so if you are selling a property held by a family company, then there are CGT exemptions to it. The main one that was also introduced years ago was around group reorganizations. So if you are within a corporate group and you're transferring property from one company to the other within the same group, then there is CGT exemption. There's CGT exemption in selling your dwelling home, so your personal private residence that you've owned for at least 3 years. For transactions less than 3 million, there is CGT exemptions. So for agricultural land of 50 hectares outside a municipality, there is CGT exemption. So there are certain CGT exemptions, even in a divorce settlement, in a transfer into a trustee. So what we would want to do in future is just give you opportunities of how to effectively structure around such a tax. But just to notify our investors that come 1st of January 2023, then the capital gains tax rate would go from 5% to 15%. And what those 6 months do is they give you room. They give you room to conclude a transaction that you had begun and that you're able to sell within those 6 months and be charged CGT at 5%. And if there are restructuring opportunities around capital gains tax, then it's good to speak to a lawyer to find out how do I mitigate this capital gains tax cost, because it becomes a cost to you who is selling. So it's when you dispose of a property, then your take home becomes lower because of this kind of tax.
Ibrahim Ali is asking, speaking of capital gains tax, can you ask Wakili how we calculate capital gain, since it's not an actual gain per se, but just on paper?
So I have discussed how capital gains tax is computed. So we usually look at the transfer value, and there was a lot of even when there was a lot of submissions to Parliament when there was a proposal, because how the Finance Act works is first you get the bill. So you get the finance bill, And before that, there's even public participation of the kind of changes you'd like to see in that law. So when the bill was published, the public was invited to give comments on the provisions that had been provided for in the bill, what should pass and what should not, what is good and what is not. And one of the propositions that very many industry players gave was the increase in capital gains tax. Because we usually say, like a country like Kenya, most of the property, the increase in cost of value is as a result of high inflation. So property that you bought many moons ago will be very highly valued, but probably just as a result of inflation and cost of living. And we all know how property prices in Kenya are high. So as a result, then we were lobbying for things like indexation, or what we call taper relief. So indexation is we reduce that gain in property, what someone here is calling paper gain. So we reduce that gain in property by the inflation rate. So we say because inflation is X amount, then this gain is not as a result of a real appreciation of property, but just as a result of inflation forces. That proposal didn't make it. It didn't see light of day. So as it is now, there is no any inflation adjustment, and you are just assessed on what you consider the transfer value. So how we compute CGT is we get the transfer value, which is basically the consideration that you would fetch from selling that property, which is what you will be paid from selling that property. And then we deduct certain expenses and costs. So we will deduct the historical cost of that property. So assuming Karen bought a house at 1.5, 5 years later, the house is 2.5 and she wants to sell it. So we will take your 2.5, which is what will be your consideration or what that property would fetch. And then we deduct your historical cost of 1.5. And then we deduct any other cost to improve that unit. So if you did additional painting, if you did additional interiors, so whatever you incurred in that. And then we take other costs like legal fees, stamp duty when you are buying that property. So if together this cost comes to say 200,000 or 300,000, then we are at 1.8. So it will be 2.5 minus 1.8. And then that is 700. Yeah, so 700,000 times 15%. So whatever that will be is what will be payable as capital gains tax. So it is purely self-assessment. You assess yourself. And unlike stamp duty, where we have to use a government valuer to assess the value of the property for which stamp duty is payable, there is an assessor who assesses. For capital gains tax is self-assessment. So you assess yourself based on market forces of that property, of course. What would call the probably market value or the arm's length price of that property that would fetch if you sell it. And then we deduct what we've discussed, and then you pay tax.
Rose Ringera is getting a bit technical here. She's one of our investors. She's asking, does adjusted cost consider inflation? I think you've just mentioned that in the conversation. So I hope, Rose, your question is answered.
It doesn't.
Irene Nyamu is asking, so will CGT affect a TSAVO buyer at the point of getting the transfer to the new investor?
So
I'm an investor. I'm an investor here at TSAVO, Karen. I bought unit A. So I want to sell it to Winnie at a certain price. Does CGT come in play at that point?
Yes, CGT comes in play.
CGT
comes in play at that point.
And that's why we don't encourage people to sell, because you buy the unit for investment. So it needs to give you passive cash flows and not include more taxes in it.
And just to use that example, so if the example that we used, we found that the difference between the consideration and the adjusted cost is 700,000, then you go and slap 15% to it. So instead of you getting 2.5, which is what your property has appreciated to, you'll end up getting lower. But if you hold it for investment, then your returns are longer and the property keeps appreciating. So capital gains tax is just one of the ways that you can you can manage your investments and avoid selling by just holding it for investment. Because the moment you sell, then the taxes come into play, and what you actually get as real value from that property is way lower.
Okay. Edwin Kiptines is asking, any exemption tax for the disabled? I lost 30% of my function because of a serious accident by a drunkard.
Okay, so I know under the Income Tax Act we have tax exemptions for the disabled. So we can come back to you on the definition of disabled, because you know it could mean anything. There have even been arguments of whether we are disabled by wearing specs. Anyway, on a light note, but I know the exemptions even on PAYE for people who are disabled. So companies should not charge PAYE on their income. But of course that has been well defined as to what is considered disabled. I know you had already talked about MRI, but I can see a few questions coming in here. So Irene Nyamu is asking, how do you handle MRI and PAYE when filing returns at the end of the year? I think this is one of like the major questions that came in June when people were doing their annual returns. So if you have interacted with iTax, so iTax is the online KRA platform where we file returns. So if you have personally interacted with iTax, there are different tabs for different taxes. So if you go to, say you want to file income tax, so say PAYE, you'll pick a category and it will say income tax, and then it will tell you which one. It will give you MRI, it will give you withholding tax, it will give you PAYE, it will give you income tax resident, income tax non-resident. So all those types of income taxes will be under each category. So if you pick, say, income tax PAYE resident, so it will give you what we call a data pack. So like an Excel sheet that just allows you to declare PAYE. If you pick monthly rental income, it will give you just a data pack that allows you to declare monthly rental income. Where is your plot, the address, the tenant, and the base, the tax base, so the gross rent, and then it will automatically compute the taxes. So the two are separate and distinct. And as I said, MRI is a final tax. So if you pay it, say, in the month of, we're now in July, so we are by 20th we should be paying MRI for June. So if you pay the MRI for June in July, then that is it. There is no further taxation of that particular income any time in the year, even when you're filing your individual tax returns. So so that is how they work. If you are a corporate and then you have, say, you're filing an income tax return for a company, you'll have business income, rental income, interest income. So each will fall under different tab, but in one Excel sheet. So you will be able to disclose all those separately. So when you're filing your annual income tax returns by 30th June every year, MRI is done. Like when you file for each month, that is done. And there is nowhere, or you're not required to declare any MRI in your personal income tax return.
I think the question here comes from a perspective of, what if I'm not within the 24K. I earn less than 24K a month. So I'm supposed to include it. You said it's included in in your annual returns, but it's net of all expenses under 30%.
Not quite. So if you earn less than 24,000 in a month from rental income, you are outside. You are outside the ambit of taxation. You don't put it anywhere. Yes, you don't put it anywhere. So if you are a company, if you are a company and you are having rental income, residential rental income, but you're also trading, so you will have your business income from the trading, and then you'll have your rental income where you'll declare, but only if you're a company and you are doing the 30%, the 30% rate for corporates, even for residential rental income. But for individuals, it is filed in a different pack. It is filed monthly and it's final. So you don't mix MRI anywhere with PAYE.
So if I'm earning less than 24K, I'm not
basically exempt.
I'm basically exempt from the taxes. Irene, I hope that answers your question. I also saw Moi asking the same question. So I'm hoping that has brought in like like a bit of clarity. Yeah. Before I go back to the questions, maybe we can talk about the next item among the major changes in the Finance Act. Yeah.
I've seen Ibrahim Ali is asking a very interesting question on REITs, and Ibrahim, that is very interesting. So REITs are real estate investment trusts, and yes, it's a very complex and interesting discussion. But let's answer what Karen is saying. So in terms of other changes in the Finance Act that I'd like to highlight is there were no major PAYE changes this year. So in terms of taxation of personal income tax, the only main change that we saw was something to do with employee share option plans, which we will not discuss in this forum. And the other change that we saw was the definition or clarification of what we call permanent home. So permanent home was defined in the context of determining who is a tax resident. So in determining whether you are tax resident, therefore taxable in Kenya for employment purposes, we consider three things. So whether you have a permanent home in Kenya, whether you have been in Kenya in that year of income for 183 days. So this especially applies to Kenyans living abroad. Yeah, so if you're a Kenyan citizen or you're Kenyan but you live abroad and you want to determine whether you are still actually subject to Kenyan taxation, the tax residency test would come about. Yeah, so whether you have been in Kenya in that particular income for at least 6 months, which is 183 days. And the third one is whether in that year of income, together with 2 preceding years of income, you are in Kenya for 122 days. So the Act provided that the first test is whether you have a permanent home in Kenya. But we didn't have the word permanent home defined. And there was always this litigation around what is permanent home. Yeah, so we have an introduction and a new definition of what a permanent home is. And that is where your place of residence or a place available to you to reside, or what the commissioner can deem as your personal and economic interest, where they are closest. So if they are closest to Kenya, then you still remain a Kenyan tax resident. So that is important, especially for people working abroad or people in the diaspora who are Kenyans. And then the other changes that we saw were around VAT. So we had a lot of VAT administrative changes and changes in tax rate of VAT. So we usually have the 3 rates, the 0, 16, and exempt. So there were changes around healthcare. And one of the key changes, which is a good thing, is the reduction of gas, LPG, from 16 to 8. So that was commendable. And then we had a lot of changes around investments in healthcare. So your hospitals, your manufacturers of human vaccine, and then we had changes around fertilizer. So we all know our food basket has gone ridiculously up in the last months. Everything is just so expensive, and that of course is as a result, one of the contributors is fertilizer has been very expensive in the last financial year and this year. And we have seen tax changes that would see the prices of fertilizers coming down. So this is manufactured fertilizer or input in raw material which are imported to manufacture fertilizer locally. So the VAT aspect to that has come tremendously. The changes have been very positive, and we hope to see the prices of fertilizer going down, which will positively affect your shopping basket and your spending ability and your ability to save more. So that is good. And then there is excise duty tax, which has been highly debatable as to what exactly is excise and whether what we are subjecting to excise duty is the intention as required by excise duty, because excise duty was introduced as what we called a sin tax, so something to deter harmful practices or negative and adverse health issues. So and luxurious products. So excise duty was on very expensive luxurious products. And back then, of course, cars were considered expensive and luxurious. But now we have seen excise duty being expanded to very many other consumables. So we have excise duty on bottled water. and whether bottled water is harmful or luxurious, we are not sure. But yeah, there's excise duty on bottled water. We've seen excise duty on cosmetics and jewelry. Actually, it's increased. It used to be 10, it's now 15%. And so for the ladies out there buying cosmetics and jewelry, your bill is just about to go up because of excise duty. Of course, excise duty on alcohol, wines, cigarettes, cigars, those just keep going up every year.
So your day-to-day consumables.
Your day-to-day, essentially.
The things you're using.
And last year, but when we saw an introduction on excise duty on imported sugar and confectionery. So your white chocolates, your cakes, your sweets are about to go up again by excise duty cost. So it might not look much, it might not seem much, but if I'm to give a context, the excise duty, the current excise duty rate on wine is 200 bob a litre. So in your bottle of wine, 200 shillings is going to taxes, and beer is around 170. So you might not think of it as much, but cumulatively it's a lot. Cumulatively it's a lot, and it just keeps increasing, you know, your cost of consumerism. So if we are going to say malls and bars are our competitors in terms of consumption, then that is where tax is actually a huge driver of what you're consuming in malls and bars, because that's where you'll find your cosmetics, your jewelry, your drinks, your sweets, your chocolates. So and excise duty is one of the reasons that those prices are going to go up. So those are just some of them. We have changes in the tax administration procedures. And because of time and also just being outside the context of what we want to discuss tonight, we'll not delve into those ones.
All right. So when I'm looking at the real estate and investment industry, of course I'm looking at how much money do I have to take back home. That means my taxes, the excise duty that's being levied on those different goods that I would buy. Not investing, then it means taxes become important. I know if I do that day, then I can't do it. So it kind of changes my mindset into what do I need to put my money more into. I think the other major change that you had talked about is, I think, the CGT. Because it's actually tripled. The percentage has tripled from 5% to 15%. So that's a major change in the real estate industry. So this is what you've tried to do here, is to just introduce Winnie into the platform for you to get to interact with her, to know her better, and so that we can use her expertise in tax and even as a tax lawyer, so that we can better invest. And I think as TSAVO, because we would like to increase our knowledge base, would like you as our investors to know a lot more about not just investing in real estate, but everything that affects your day-to-day life, where you put your money, and taxes play a major role in that. So when we said at the beginning, we have a lot lined up for taxes. We are looking to talk about a lot more. So things like taxation of real estate. So what are the taxes that are involved in real estate, and further expounding on how to go about them. What are the exemptions available when I'm looking at the taxes that are within the investment I'm taking, in this case real estate. What are the exemptions available? And Winnie will be able to expound more on that and outsource as much knowledge as she can, so that she can inform you better. And then also just efficient tax structuring opportunities. So how can you structure your taxes in such a way that you have more to take into investments? Because we want you to build more on your investments and have your money work for you in every way possible. So I think for me it's to thank you for the opportunity, sitting with someone who's had 8 years of experience. I'm just looking at 8 years like that's a lot. Wow.
No, that's very different.
Yeah, that's a lot. Thank you for everyone who's tuned in. Thank you for everyone who stayed with us up to this period. Like I said at the beginning, we are on the journey to 3,000 subscribers. If you've not hit the subscribe button, please make sure you do so. I can see so many comments coming in. I hope all of you have been informed. Maybe just one last one. I've seen a very the very last question that comes in from Sami Kimaru.
Yeah,
he's saying we've talked about those people who are below 24K. What about someone who's above 15 M?
Yeah.
Hey, Sami.
Sami, thank you. I've seen that and taken note of that.
Yeah.
So MRI was introduced as a simplified method to account for residential rental income.
Yeah.
And it was simplified in the regard that it was a monthly return. It was no complex computations. Just take what you earn, slap 10% and you pay.
Yeah.
That was the intention of MRI. And so they thought it wise to put a band between the 288,000 a year to 15 million a year. So if you fall, if you are earning residential rental income above 15 million a year, then you fall under the corporate income tax band. So you account it and as well, you could be an individual, but you account it as under corporate residential rental income. Let me call it that way.
Yeah.
And how that works is you hit the 30% band, you go to the 30% band, and when you go to the 30% band, then it allows you to take a deduction of expenses. The idea is this is a big project, this is a big investment, and your investments are, even your costs are higher. I mean, you have a big agency fee, probably, agency cost for someone to manage for you those properties. Your repairs have increased because you're no longer managing 2 units to maybe a whole block of flats. So you have high repair and maintenance. You are probably electricity bills that you are supplementing, or your borehole water charges are more. So it sort of moves you to the more complex corporate kind of accounting. So you take your gross rent, so what you would earn, assuming it's 18 million, and then now it gives you a chance to deduct expenses. So you deduct all your expenses, and then that is accounted for annually. You don't do it monthly, you do it annually, and then you file it together with your annual return. So if you are if the residential rental block is managed through a company where Sami, you're a shareholder, then that company would be the one to file that return. If it's managed under you, it will still be personal income tax return, but now at 30%, because it is now gross rent minus expenses. So that's what happens for bigger and high value sort of residential rental. And maybe just to mention that if you are commercial, so if part of your rental income is commercial, then you do not fall under MRI at all. So you go into corporate rental income, where again you pay 30% annually, deduct with an allowance to take a deduction of expenses. And then you also remember that if it's a corporate space, commercial space, then it has VAT. So you're supposed to charge VAT on your corporate lease. Monthly residential space doesn't attract VAT. So I should not be charging VAT on it. And maybe as Karen has said, we will plan a tax session, basically of real estate, where we will deep dive into now these areas, because I'd like to highlight very many things, including what's the difference between an Airbnb, so what you consider short stays, and residential rental. So if you are leasing out your space, your apartment, for short stays, then you automatically move into the commercial space. You are no longer in the residential space. So residential space is long-term stays. So and that's something investors and should know, because some of them buy and put it up for Airbnb. Some of them buy the investment and put up a commercial place. You know, the shops on ground floor, the restaurants. So the moment it becomes commercial, then you are technically not under MRI. So it becomes commercial, and ideally you should charge VAT on that space, and you should account for it in the annual basis way. So part of the things we want to empower our investors and our viewers with is the taxation of real estate, so that we're not just talking about capital gains tax, but we'll talk about VAT, we'll talk about withholding tax, we will talk about taxation of income tax for real estate, and also CGT and stamp duty, and how to efficiently structure around those taxes. So subscribe, and wait to see what will be lined up in the next tax series.
Ibrahim is saying he's very, very excited. He's learnt a lot, and he can't wait for the next one. I think our viewers are really liking this. Another thing I wanted to mention is on the 31st of July this month, one of our producers, Ben Migwi, has organized for TSAVO to go to a children's home and spend, so it's his birthday, so he's going to spend it at a children's home.
Wow.
To just make those children feel like they have family, they are with people, and because it's a cold season, so we're taking everything we can get. So we've gotten TSAVO to actually build into whatever we're taking to them. So there's a poster up on Mchanga details, and a link will be shared in the comment section on just how you can go about contributing to this what do I say? Yes, to this noble cause. Not all of us can organize such things. Not all of us can celebrate our birthdays in a children's home. So this is actually big for us here. Then again, Winnie is from Mark & Partners. I'm sure if you're an investor here in TSAVO, you've invested in Skywalk, any of our projects in Royal, TSAVO Studios in Embakasi. I'm sure you've gotten a chance to interact with them. So Winnie is a partner at Mark & Partners, and so in case you have any questions, you'd like to reach out for more tax guidance, more lawyer guidance, feel free to reach out to them. Her contacts and their details are also in the comment section. Then again, let's not forget tomorrow TSAVO is going to the diaspora. So every investor, if you're watching this in any part of the UK and you're willing to join us in the locations we had earlier mentioned, and I think we are putting up that poster of the locations we'll be at. If you're able to join us and be with us, come engage with us. For some of you, you've really trusted us and you've invested in this unit, even without coming back home to check and see. You've trusted the site updates that you've been giving, and would really like to meet you so that you can get that human feel that the investors here in Kenya get, because our offices are located here. So come many through the events. Reach out to Martha. Her details will also be dropped in the comment section, so that you just reach out to her, organize, book your sessions to meet up with them. And as we conclude, again, subscribe. We're on the journey to 3,000 subscribers. Get as many friends into this so that we can all learn, so that we can all we can all gain more knowledge and increase our knowledge base, both on taxes and everything investment and real estate. So thank you guys. Thank you for the participation. Thank you for being here, and see you next time in next week's webinar. We have something big. Waiting for you. This one you're not ready for sure. So
TSAVO is full of surprises.
This one you're not ready. Trust me when I say you're not ready for this one. So see you next time. Have a good night.